Welcome back, guys. Today we're going to be discussing Netflix stock. We're going to be going through some financials, also a little bit about the company, and a discounted cash flow model at the end. So, checking out their 5-year chart, they are up 72% in the past 5 years. That actually underperformed the S&P 500, which is interesting. But if you timed your buy correctly and bought them at $180 a share back here, you'd be up more than 3x at this point. This right here, it was a generational buying opportunity, and it's unfortunate if you missed out, but yeah, that was an amazing buying opportunity at that point. But now after the run up, we're going to check and see if it is still a buy or if it is a good time to sell the stock. It is a $275 billion company, absolutely massive company, the biggest streaming company in the world, with a price to earnings ratio of 51, which is very steep. So they have to have some growth to back that up. Also, their margins are pretty decent. So an increase in margins isn't really going to help that a ton, although it could. So let's take a look at the financials. Taking a look at the statements, they are up in revenue a lot. The past couple of years, they've only grown by 6.5%, although in the last quarter, they grew by 12.5% in revenue. And they are expecting that moving forward at a 12.5% growth. So that is kind of interesting. Also, their margins are about 15% each and every quarter. They spend a lot of money on content. So they could increase their margins a lot if they just didn't spend so much money on content. Also, let's check out their balance sheet. They have 10 billion in net debt, which really isn't that much when you consider their income is 5 billion, and they could pay that off in just a couple years. In terms of cash flow, see what they're doing with their financing activities. They are buying back some stock. They actually bought back quite a bit of stock last year. Surprisingly, they didn't buy back any in 2022. I kind of wonder if they bought back the stock in 2023 on that dip, but it doesn't look like it. It looks like they bought back most of their stock in Q3 and Q4 of this year. So unfortunate, but they didn't buy back any stock on that massive dip, which is really odd. I would think that the company would want to buy back stock on those massive dips, but yeah, that's really interesting to me that even Netflix missed out on that. So in terms of their stats, we're looking at their ROIC, pretty high, going up to like 15%, between 10 and 15%, and then their net margin is, yeah, follows pretty closely. They got their net margin up to 15%, and I do expect that to continue to expand with their massive economies of scale, especially being in the streaming business. It really benefits them to have scale. So let's take a look at a couple of their investor slides that I want to take you guys through. Right here, we're going to look at their revenue per region, and we're looking at US and Canada. They make the bulk of their money from US and Canada. They have paid memberships, 74 million, and continuing to go up to 80 million. So super continuous growth in their memberships, and that's for every single region. It's just continuous growth in memberships, and the revenues for LATAM and Asia Pacific are lower than, of course, US and Canada. Looking at so this right here, their revenues, and then their cost of revenues right here. This is mostly spent on content. I actually looked up how much they spend on content, and Google just spat out 17 billion. That's how much they spent in 2021 for content. So they could definitely decrease the amount that they spend on content and really increase their margins a lot, like a lot. And then they spend a bit on marketing and technology. Got to pay the people coding your stuff and administrative costs. Also, they have some interest expense with the amount of debt they have, but it's not too concerning. taking a look at their analyst estimates, we've got 17.16 going up to 21, which is like a 20% increase in earnings. And then we have their revenue estimate at 38.61 going up to 43.34. They are estimating a 12.3% revenue increase going into 2025, and the company is projecting like a 12% increase for this year, basically. So I put that stuff into. Also, we could take a look at insider buys, and the insiders have actually been selling a lot. So these are all insider sells, and yeah, they actually sold the most last quarter. So that is not really the best thing to see, especially when you're looking at the CEO, chairman, and this guy sold $38 million worth of stock here. So that's usually not the greatest thing to see, although usually they hold a lot more stock than what they're selling. So a lot of times it's not that big of a deal. Now let's take a look at the discounted cash flow model. So this is like probably the worst case scenario for Netflix is what I have in right now. I am going to adjust these numbers a little bit and see if we can come out with a more rosy picture. But if this scenario plays out, they are looking a little bit overpriced. I put their EPS estimate here, revenue estimate here, buybacks, net debt, discount rate of 10%, and an exit multiple of 22. I just think that their multiple really has to decompress after 10 years, especially since you can't really expect growth to continue forever. So although an exit multiple of 22 is still pretty decently high, so it's not doing Netflix too dirty there. In terms of earnings growth, they are expecting 20% next year, and so I just put their earnings growth just slightly declining year over year. And if this scenario plays out where their earnings decline to 10% a year, then we're looking at about $560 a share as a fair share price. And then we're looking at the one with revenue and margins. And wait, the analysts are estimating 12% growth, so we can put that in there and maybe 10% instead, and maybe 7 declining to 5. And profit margin of 15%, that's what they've done in the past. I do think that they could expand these profit margins quite substantially over time. So that could be adjusted as well. And if you're going to invest in a streaming company, I would suggest Netflix just because they benefit the most from their economies of scale, and they spend the most on content. Most people like them. I think they could definitely get up to 25% margins if they just spent a little bit less on their content. But yeah, with them trying to grow so fast, that's why their margins are kind of suppressed at only 15%. Also, it's possible that they grow a little bit more than this. Also, they have a runway for growth basically indefinitely into the future because they have amazing pricing power. They can always keep up with inflation. This is the direction that the world is heading. The world is heading into streaming and streaming only. A lot of people that I know, they don't even worry about TV. They just stream. They just watch stuff using the internet. And the internet is always expanding into different countries, different territories. And Netflix is the leader in streaming entertainment. So you definitely don't want to bet against Netflix. You could even argue that this exit multiple is too low and say that maybe an exit multiple of 30 would be more fair for Netflix because of that long runway in growth. And using an exit multiple of 30 and assuming that this scenario plays out, which definitely could happen, then we're looking at a fair share price of about $640 a share, which would make it fairly priced at this moment. And you would be expecting a 10% return moving forward. And yeah, I definitely think that this could happen. Exit multiple of 30, totally fair for this company, being that it has such a wide moat. Well, I don't know if it's like such a wide moat per se, but it's like it's got a moat in terms of it can offer the best pricing with the best content. And since it reaches the most amount of people, then nobody else can really compete until they get to that large of a scale. So it's basically just because they're so big already, it just benefits them so much more with going forward. Like it's kind of opposite the way you would think, but yeah, the size of them already really helps them out a lot. Yeah, that's what I would have to say about that. Uh, yeah, definitely don't bet a net don't bet against Netflix. And yeah, you could try this spreadsheet out for yourself if you think my numbers are off or whatever. And leave any questions, comments in the comments section. Hit that like button, and I'll see you in the next video.